You have probably heard the simple story of how money began. A farmer had eggs, a baker had bread, a hunter had meat. And because trading one thing for another became too complicated, humans invented money. It sounds obvious, but it is probably wrong. For more than a century, anthropologists have searched for a real society that lived mainly on barter before money existed. They never found one, not one clear example. The barter story is not the real origin of money. It is a myth because it feels simple. Money did not begin as a clever tool for shopping. It began as debt. And once you understand that, the whole history of money becomes much darker. Money is not just coins, paper, gold, or numbers in a bank account. Money is a record of who owes what, a record of who controls the system, and a record of who can change the rules. And here's the disturbing pattern. Every major form of money follows almost the same path. People invent it, people trust it, power captures it. Then its value is slowly drained. Shells, coins, paper, gold-backed money, fiat currency, and now digital money. The material changes. The trick stays the same. This is the story of money, and it begins long before coins. Imagine a village thousands of years ago. You help your neighbor repair a roof. He does not pay you with coins because coins do not exist. He simply owes you. Maybe later he gives you grain. Maybe he helps you during harvest. Maybe his family repays your family another day. The debt lives in memory. That was the first form of money, not an object, a relationship, a record inside the community. But as villages became cities, memory was no longer enough. So humans began writing debts down. In ancient Mesopotamia, temples and palaces recorded debts in silver, grain, and labor thousands of years before the first coins appeared. Money was not created to make trade easy. It was created to keep score. And once someone controls the scoreboard, they can change the game. As societies grew, humans needed physical objects to represent trust, something visible, something portable, something everyone accepted, so they tried almost everything: cattle, salt, grain, shells, metal, beads, even giant stones. On the island of Yap, huge stone discs were used as money, even when they were too heavy to move. What mattered was that everyone knew who owned them. Across Africa and Asia, cowrie shells became one of the most widely used currencies in history. They were small, recognizable, and hard to fake at first. But scarcity is fragile. If outsiders flood a region with cheap shells, the local money can collapse overnight. The shells are still there, but the belief is gone. And when belief dies, money dies with it. Then, around the 7th century before Christ in Lydia, rulers found a harder solution. Their rivers contained electrum, a natural mix of gold and silver. It was valuable, but every piece had different purity. So the Lydian kings melted the metal, fixed the weight, fixed the purity, and stamped each piece with an official mark. That stamp was a promise. The ruler guarantees this. You no longer had to test the metal yourself. You trusted the authority on the coin. This was one of the first true systems of coinage, and it spread fast. Coins were easy to carry, count, pay soldiers with, and collect taxes with. But something dangerous had happened. Money now carried political power. The ruler's symbol was in your hand. And once rulers understood that, they discovered a trick almost no government has ever resisted. They could make money look the same while making it worth less. Rome turned that trick into an art. The Roman denarius began as a trusted silver coin, but empires are expensive. Armies must be paid, borders must be defended, loyalty must be bought. So emperors collected silver coins through taxes, melted them down, mixed in cheaper metals, stamped them again, and sent them back out. The coin looked the same, but it contained less silver. At first, people barely noticed. Then prices rose. Old good coins disappeared because people hid them and spent the bad ones. By the 3rd century, the denarius had lost almost all of the silver that made it trustworthy. Rome learned how to drain value quietly, and the pattern returned again. Rome did it with silver. China did it with paper. In China, carrying heavy strings of copper coins was exhausting. So merchants began leaving coins with trusted shops and carrying paper receipts instead. At first it was brilliant. Paper was light, trade became easier, wealth moved faster. By the Song dynasty, the government issued official paper money. But paper has one fatal weakness. It is much easier to create than metal. A coin must be mined, melted, and struck. Paper can simply be printed, and rulers printed, then printed more. The notes still looked official. They still carried authority, but the value behind them kept thinning. Eventually, the system weakened, and later dynasties returned toward metal. Different empire. Different material, same ending. Money became lighter and faster, but also easier to corrupt. Then Renaissance Italy changed money again. Money no longer had to sit still. It could move invisibly. The Medici of Florence became masters of this new system. Their bank did not become powerful by mining gold or conquering land. It became powerful through credit, paper, exchange rates, and distance. The church had condemned interest on loans as a sin, so bankers disguised it. A merchant could deposit money in Florence and receive money later in London in another currency. The bank's profit was hidden inside the exchange rate. It looked like currency exchange, but underneath it worked like interest. Money became a network, invisible, fast, and abstract. And the more abstract money became, the harder it was for ordinary people to see where value was being taken. For centuries, the world tried to fix this by tying money to something rulers could not easily create. Gold. A paper note was a promise. You could take it to a bank and exchange it for a fixed amount of gold. That meant the money supply was limited by the gold a country actually held. It was a chain, and for a while, it worked. By the late 19th century, much of the trading world had moved toward the gold standard. Prices became more stable. Currencies became more trusted. But gold has one problem. It does not care about war. When war comes, governments need more money than their gold reserves allow. So during the First World War, country after country suspended the gold rule and printed what it needed. The anchor held only when it was convenient. Then Germany showed what happens when the anchor disappears completely. After losing the First World War, Germany owed enormous payments it could not afford, so it printed money around the clock. By 1923, the currency was collapsing. Prices doubled in days. A loaf of bread that once cost a few marks could cost billions. Workers were paid with stacks of notes and rushed to spend them before prices rose again. Savings built over lifetimes vanished. Some people burned banknotes because the paper was worth less than firewood. When money dies, it does not only destroy prices, it destroys trust. After the Second World War, the world needed a new system. In 1944, representatives from 44 countries met in Bretton Woods, New Hampshire. The deal was simple. The US dollar would be tied to gold. Other currencies would be tied to the dollar, so the world no longer trusted gold directly. It trusted America's promise. For about 25 years, the system held. Then the United States began spending heavily on war abroad and programs at home. More dollars moved around the world than America had gold to back. France noticed and demanded real gold. The vaults began draining. On August 15, 1971, President Richard Nixon announced that the dollar could no longer be exchanged for gold. He called it temporary. It became permanent. In that moment, the final link between the world's money and a physical object was cut. Money became pure fiat. Fiat means something like, let it be done. Fiat money has value because the government says it does, and because everyone agrees to accept it. The money in your wallet is not a claim on gold. It is not a claim on silver. It works because people believe the system will still work tomorrow. But once money is no longer tied to something scarce, there is no natural limit. New money can be created through policy, debt, central banks, or numbers on a screen. The Roman trick did not disappear. It became modern. Instead of mixing copper into silver coins, governments expand the money supply. Instead of shaving metal, they dilute purchasing power. The number on the bill stays the same, but every year it buys less. And because it happens slowly, most people call it normal. Then came 2008. Banks had built mountains of risk on top of home loans that were treated as safe. Those loans were packaged, sold, insured, and leveraged until almost nobody understood how fragile the system had become. When housing prices stopped rising, the machine cracked. Lehman Brothers collapsed. Markets froze. For a moment, the global financial system looked like it might stop. Then governments and central banks created trillions to rescue it. The institutions that took the risks were saved. Millions of ordinary people lost homes, jobs, and savings. And many asked the same question. Why do we trust these institutions with money at all? While the crisis was still unfolding, someone offered an answer. On October 31st, 2008, a person or group called Satoshi Nakamoto published a document describing Bitcoin. Money with no central bank, no government issuer, no single company in charge. Instead of trusting an institution, users would trust a public record shared across thousands of computers, a ledger anyone could inspect but nobody could secretly rewrite. In a strange way, Bitcoin returned money to its oldest idea, a record of who owns what. But this time, the record did not live inside a temple, palace, bank, or government office. It lived everywhere at once, and the supply had a hard limit. Only 21 million Bitcoin can ever exist. No emperor can dilute it. No central bank can print more. No politician can quietly change the supply to pay for a crisis. At least, that was the promise. When Bitcoin launched in January 2009, its first block contained a message about bank bailouts. It was not just code, it was a protest. For the first time in thousands of years, there was a form of money designed to resist the old pattern. But power does not ignore money. It never has. Governments watched digital currency rise and learned a different lesson. If money is going digital, then official money can go digital too. That is the idea behind central bank digital currencies, or CBDCs, a national currency issued digitally by a central bank. At first, it sounds convenient. Fast payments, no cash, simple transfers. But there is a difference between digital money you control and digital money that can control you. Cash is private. A state-issued digital currency may not be. Every transaction could be visible. Money could be programmed. Payments could be blocked, limited, tracked, or even set to expire. That does not mean every CBDC will be used that way, but it means the possibility exists. And history shows that when power gains a new ability over money, it rarely ignores it forever. Money began as a memory of debt. Then it became shells, then metal, then coins, then paper, then bank credit, then gold promises, then fiat, then numbers on screens. Now the next form is being built, and the question is no longer only what money is worth. The question is, who can see it? Who can create it? Who can freeze it? Who can change the rules? That is why the history of money is not really a history of objects. It is a history of control. Every ruler in this story understood that. The kings who stamped coins, the emperors who diluted silver, the governments that printed paper, the banks that hid power inside contracts, the states that broke gold promises, the institutions that created money to rescue themselves. Money has never been just money. It is the quiet machine underneath civilization. And the oldest trick works best when the people using the money are not paying attention. But now you are paying attention. So when the next version of money arrives on your phone, in your bank, or inside your country's payment system, the real question will not be whether it is fast. It will not be whether it is convenient. It will not even be whether it is digital. The real question is the same one humans have faced since the first debt was written down. Who controls the record, and what happens if it is not you?